Welcome to the Daily Update. This is being prepared Wednesday, October 26th, where we'll look at the action in the market today and then see how things look for Thursday, October 27th. And I apologize beforehand. You'll probably hear some background noise. I tried to go to a quieter place, not as good acoustically when I'm doing the recording, and you're probably going to hear some noise that I just can't seem to control right now. We saw a bit of a pullback on Wednesday. Not really surprising. We were becoming overbought. We were up against resistance and we fell back a little bit, but the positive side is still holding up, at least as of right now. We'll have to see. Are we going to see some more downside action after this? If we do, what's the intensity of that downside action going to be? Are we going to chop sideways for a few days? It might be likely that the market's going to set itself up for the report coming out on Friday, which is another inflation gauge. We also have an important report coming out on Thursday. That's the first or advanced report on GDP. Those are two really big things. So we'll have to see how the market can handle those things. And there'll be the knee-jerk reaction, and then there'll be kind of a longer term reaction, and then the professionals at some point will come in and then take prices the way that they want them to go. So let's go back and talk about the day. Right at the open, we had a lower open and we were down below the daily pivot at 38.40. As the day went on, prices did rebound and actually went positive, and we rose all the way up to R1 at 38.81. But there wasn't a lot of conviction behind this. We weren't seeing broad-based advances, and the value side was really outperforming the growth side. So this just didn't have an awful lot of legs. Prices ended up declining. We went back negative. We dropped below the daily pivot. It wasn't really hard to see that one coming. We were down 0.74% on above average volume. And the technicals, they're still holding up. We're still leaning more with the positive scenario right now. But we were overextended in the short term, at least. And so to see a little bit of downward to sideways action is not really surprising. But we want to see, are things going to hold up? Are we still going to continue with this positive slant that has been developing? Inflation and interest rates, that's the real fixation. It's going to be seen in GDP on Thursday and in the PCE deflator on Friday. Geopolitical concerns, those are still right at the forefront too. Russia, Ukraine, and the whole situation there that could escalate to the point where it might impact the market. Things have kind of calmed down a little bit now in the UK. It was kind of weird there. The British pound is doing a little bit better. They seem to have stabilized a little bit there. We still have a lot of earnings that are coming out. That's kind of what drove things in Wednesday's session. Microsoft and Google, two powerhouse companies, and they came out with earnings that were seen as disappointment. And so both of those stocks were taken lower. And we don't have any Fed speak that we're dealing with right now. We do have the midterm election coming up, and the debates that have been going on, not sure if that really is going to have any impact one way or the other. A lot of people may have made up their minds already, but it'll come down to not necessarily who wins or loses, but what does the policy, what does that look like? That could eventually feed over into the stock market, but that's longer term. So some comments are that Boeing, Microsoft, and Google, I forgot to mention Boeing, they had disappointing earnings reports, and they're big monster companies. And so when they go lower, that can really have an impact on the markets. Interest rates did decline, so we are seeing that, and that can give some support to stocks. Didn't really help all that much towards the end of the day, but that if that continues, that could help stocks to advance. And this scenario that the Fed might consider lessening their interest rate increase in December, that still seems to be valid at this point. They're still going to do their 75 basis point in November, but in December, instead of 75 basis points, maybe they'll do 50 basis points instead. Now, there's a lot of things that could happen between now and then. There's a lot of economic reports that are coming out, but this is kind of the scenario that the markets are sticking with, at least for right now. Small and mid caps, they held up fairly well, even though the S&P was down. The other indexes did a bit better, and we've got more yield curves that have gone back to being inverted. The 10 to the 5, the 10 to the 2, that's been that way all along. The 30 to the 5, which had not been inverted as of yesterday, went back to being inverted today. And then the 10 to the 3 month, which was inverted last week for one day, well, it continues to be inverted now. So we're seeing more across the board inversion, which that's suggesting that this recession, if we're not already in it, is really just kind of a foregone conclusion. Then sentiment is turning more positive. We're out of the neutral area and actually getting slightly into the greed area. So, and we follow that. If it's going up or going down, we can use that to our advantage and go the same way. It's when it gets to the extremes, that's when we look to be contrarian at that point. The weekly MBA mortgage application index, as we've been seeing over and over, last week it fell 4.5%. This week it fell 1.7%. The advanced international trade in goods, it was at minus 92.2, a little bit more than the last time when it was at 87.3 billion. The retail inventories, they declined. This could be a little bit encouraging because that means they're not keeping a lot of things on their shelves. The last time it was at 1.4%. This time it declined to 0.4%. And the wholesale inventories also saw a decline from 1.4% down to 0.8%. This is probably the biggest report that came out, and it was actually stronger than expected. We have been seeing a lot of weakening data as far as the housing market is concerned. Well, they expected 575,000 new home sales. They got 603,000. Last time it was 677,000. So it is going down, but it didn't go down as much as they thought it would. Our trend is still positive. The green line has crossed over the red line, but it is weakening because those two lines are pretty close to each other. The ADX is declining, but we're still above 20. Even though we had the down day, I kept the bias at mixed, and that was because the small caps, the mid caps, the Dow held up better. And so I just decided to go with the mixed, even though the S&P declined. And our momentum, I'm still keeping more in the positive camp, at least for right now. Now, if we see some really intense selling, that could change rather quickly. All right, so sentiment, see, we're up to 56 now. We're getting into the greed area, but not extreme. We'll really start to take more notice of this if we get up into the 75 or above area. But this just shows how sentiment has been improving in the stock market. Here's an Isabel net chart. This is where they say we expect both lines to rise next year. This is the dollar inverted. That's the blue line. The dollar's actually been going up. Well, they flipped it upside down to make it look like it was going down so that they can compare it to the Goldman Sachs portfolio, international versus domestic sales exposure, and that has also been decreasing. Now, what they mean by this is they expect the dollar to go down and there to be more exposure in the portfolio. And that's kind of the scenario that I've been portraying, that the dollar's been really strong. That's taken a bite out of corporate earnings. It's taken a bite out of commodities. If we do see some dollar weakness, that could help give support to stocks because the earnings will look better. And that could also give some support to commodities. Another one, this is just a look at GDP right before we get the initial reports showing in the third quarter. This is the one that we're focused on right now. And they expect it to be at 2.4%. They expect it to be at 1 in the fourth quarter. Then it might dip a little bit down here, but it's still expected to be up in the first quarter of 2023. And so Goldman Sachs, anyway, is still looking at the position that we're not necessarily in a recession. Now, here are 2 quarters right here, and that's the definition of a recession, but they see us coming out of that pretty quickly. Then it says, what happens globally when inflation hits 8%? Well, we're there, at least on an official level. On a realistic level, it's more like 17, 18%. And this goes back to 1970 with 126 observations, with the current US EU consensus included. Of course, we didn't have the euro back then, but the median right here, that's the blue line, is that we are going to see a trailing off here with the growth. And then the current US cycle is actually showing a decline, and they're really seeing a lot of problems in the Eurozone. So we're well below what has normally happened historically, at least going back to 1970. Then we have the Fed funds against the earnings growth rate. And this is, you've probably heard this before, don't fight the Fed. Well, when the Fed is raising interest rates, that bites into earnings, which bites into stock prices. So the Fed funds rate has been going up and earnings have been growing less. And then this is rent growth. It says alternative measures of asking rent inflation peaked earlier this year and have since moderated, but it's not showing up in the CPI. So here we have the Yardi matrix right here. That's the blue line where rent had really been going up and is now coming down. You have the apartment list, that's also been declining. And the Zillow, that's the blue line in here, they topped out and are declining. But right here you have rent, which has been increasing, but it really hasn't matched up to the decline. But they figure that it's getting closer, and it hasn't really been reflected yet in the CPI. Then the buybacks, they continue to show a little bit of deceleration in the last week, but it's still higher than it has been here in quite a while. And then the overall equity positioning, they're still down here at the -1 standard deviation, so it's below average. People are afraid to be in stocks right now, so that's why we've seen this line really decline. Then this chart is just showing the annual change in the global equity market cap. And year to date, okay, there's $30 trillion has been wiped out globally that existed at the beginning of the year, but doesn't exist now. Now this will change, and if the market recovers and starts to go up, this will improve. But it just shows last time we were at this level was during the great financial crisis. Could we see this as some kind of a contrary indicator? It's like, has everybody sold that wants to sell? And now there's no sellers left. So now you can just buy. And a lot of times that's how market bottoms happen. Then here's the RIDEX bear bull ratio, the most current reading. And I always have to squint to see the date. This is as of Tuesday. And it shows that we have been declining where the market's been going up. So people are getting out of the bullish or the bearish funds, but it's still pretty extreme. Overall, they're still pretty pessimistic about the conditions of the market. Here's what I was talking about, where value was up 0.61%, growth was down over 2%. And a lot of that was Microsoft and Google because they're more into the growth area. But some of the other indexes were actually positive and held up better, even though growth underperformed with the mid caps as well as the small caps. So this is why I'm keeping more of a mix. If you look down the middle, where the S&P was down, but the mid caps and the small caps were up, that's how their ETFs ended up behaving. So that's why I'm sticking to the mixed side of things. Even with a down day, we're seeing the VIX decline, both on a closing basis, and we're dropping down below this moving average, and we're seeing it decline, and we close near the bottom with the bar, and we're seeing the VIX of the VIX. And this is what I pointed out yesterday, where if you look on a closing basis, we might be coming down to a point where this could hit support and turn around and go back the other way. If this starts to go up, that means the VIX is going up, and that means stocks are going down. The Ulcer index is really dropping off now, and it's probably a little more extreme than I would like to see right now, but we should be a little bit under the red moving average currently because we're more into the greed area. But to see this big of a drop was kind of a surprise. We're down 20.5% going back to the all-time high. The equity put call ratio did advance since the S&P declined. So people are doing a bit more hedging, buying more puts than calls. But overall, on a 5-day period, we still continue to decline. We're still working off of this extreme reading, which is a possible positive setup. Here is the chart of the pivot levels for Thursday's session, both the R and the S levels, which has been posted on the YouTube community tab. Here's the daily chart where we came up to the 50-period moving average. We broke above that, but then closed down below it. This could be a continuation of resistance that the market has to deal with. So what will change things to being more positive is if we can get back above this 50-period moving average and then close above that. And then down at the bottom, you can see where volume picked up and was above average. Our short-term fib levels, we came right up to another fib level, and that was the high for the day. And then we spent the rest of the day coming down. So we have some pretty significant overhead resistance above us, but we also have now, which could usually acts as support. We broke through what had been resistance, and if we start coming back down, we'll want to see, can this level still hold up? Longer term, we're still above this level, and it's just interesting how all these things kind of come together in different time frames. We're still slightly above this double fib retracement level. And then we're right on. How's that for lining up? 38.2% retracement level on the weekly chart above the 200-week moving average. So this is kind of all still converging on each other. So we want to keep an eye on these different support and resistance levels. We're right in the middle of our trend channel. Looking at the sectors, we had a down day. Communication led things lower, followed by tech. And that's the Microsoft, Google area of the market. Energy was up, not really strong, but at least it was up the most, followed by healthcare. And then our energy sector is still showing the best looking chart overall, followed by the healthcare chart, where at the bottom you have real estate showing the weakest looking chart. Here's energy that has just been the monster performer in 2022, even though it gave back a lot of those gains from earlier in the year. It's now been able to recoup those, with healthcare in second place and utilities in third place. Communication and discretionary and real estate are the weaker areas. And then here's just an update of, here's the pink S&P 500 and how the other indexes have performed since the all-time high. Technical alerts, some positive, some negative. A lot of these had to do with the NASDAQ. We don't have any S&P 500, where the NASDAQ went above 11,100, then 11,000. The euro got back above 100 because we're seeing some dollar weakness. Then the NASDAQ fell below 11,100, 11,000. We're seeing some BPI crosses with the cyclicals above 50. We're getting into a little more extreme positive territory with the industrials. The Dow was able to get back over 32,000. Tech had a BPI cross above 70. The staples are turning more positive. That's more of a defensive play. The NASDAQ got back above 11.2, and oil had a bullish MACD crossover, and the dollar went below 110. So dollar weakness, and that's kind of why the market was able to hold up a little better. Our scores, the Dow, it dropped 3 points, but it's still the best looking technical chart. Then small caps also declined, still looking okay. And mid caps still continue to hold up a little better. We lost a lot of points. We were showing a lot of improvement with the SPY, but we lost 12 points in Wednesday's session. And the Qs lost 23 points. A lot of that's the decline from Google and Microsoft and just the overall weakness that we've seen. Because if we are going to go higher, we need the Qs, or the NASDAQ 100 and the NASDAQ, to really start to perform well. It looks like they begin that process and then fall back. So we'll have to see if we witness any recovery in that area. All right, so we had a lower open below the daily pivot. We were able to get back above the daily pivot and go positive. We came right up to R1. That was the high for the day. Trailed off, went negative, came down to the daily pivot, danced along there for a little while, broke below the daily pivot, and then ended up closing right about where we opened. So it was kind of one of those treadmill days. Our trend is positive. I have buying on top here because the green line is on top and the red line's on the bottom. But because these lines are pretty close to each other, the ADX is declining, but it's still above 20. Arun not changing. It's just kind of going flat for right now. We did see a little bit of an advance. We saw a little bit of improvement with our breadth. We advanced slightly based on price and volume. So that's encouraging on a down day. And then our advanced decline ratio continues to show more improvement and is actually positive. Our new highs, new lows, we saw a little bit of a breakout. That blip that we made up to R1 earlier in the day, that produced a lot of new highs at that point. So that is helping the internal structure to continue to have more of a strengthening mode. Accumulation distribution, it did decline, but it's still above the moving average. Short term, this is where we're seeing things being more overbought and a bit of a pullback, where we came right up to the 50 period and we're coming back down. The rate of change going back 5 periods is still pretty extreme positive. Going back 10 periods, rolling over a bit, but still extreme positive. The Stochc RSI, still extreme. So we haven't really worked off this overbought condition. Williams percent R, extreme positive. The force index, not quite as extreme as it had been, but it had declined, where the Swinland trading oscillator continues to be positive based on price and volume. McClellan oscillator, after giving us a pretty extreme positive reading, declined not very much though. And our 20 period declined, but not very much. We're flat with the 50 and we continue to advance with the 200. Our stochastic, again, not really working off this overbought condition. We're still extreme positive, even though we declined with the short-term stochastics. We're extreme positive with the intermediate term, but we're still looking positive with the long term. Here's the 50 period moving average, where we came right up to the simple moving average, actually got a little bit above it, but then declined below that, but we're still above the exponential moving average. So we're back into no man's land again. Here's our intermediate term rainbow, where we're trying to come up into the underside, but so far that has been rejected. The market's going to need to get some real power to get back up into this rainbow. Here's our tree, showing pretty much the same thing, how we're between the 50 period simple and exponential moving average, and the 20 period moving averages continue to turn up. Looking back 50 periods with our rate of change, this is still oversold. So it's trying to bounce up out of this, but has not really done that yet. We're pretty much flat with the Sean trend meter, but still positive. Our PMO continues to be positive, but on the short-term basis, those PMOs that are rising, rolling over a bit, still extreme positive, as are the buy signals, but we're showing some improvement with those that are above zero. Chaikin oscillator declined a little bit, but is still above this moving average. Chaikin money flow also declined a little bit more. So that was more negative. And volume picked up slightly, so we're trying to come back above the moving average. The vortex continues to be positive with the green line on top. Summation index, and based on price and volume, continue to advance because the McClellan oscillator is still giving a very high reading. All of our oscillators still continue to be positive. The BPI, with that earlier rise that we saw up to R1, that generated some new BPI signals. And again, just to review that, the bullish percent index, or the number of point and figure buy or sell signals, it's not based on time, it's based on price. And so when this is going up, that means that there's some real strength happening. And the inverse of that is also true. The ease of movement continues to advance and is above the midpoint. The ultimate oscillator did decline, and the money flow index also advanced. It's more positive. We're still looking extreme with the CCI 14 and the CCI 20. But with the percent B indicator, we did get an extreme positive reading and had that come down. So that, at least in the short term, that short-term overbought indication has been worked off, but a lot of the other ones have not. TTM squeeze still showing with the pale blue lines that we're showing some improvement. Balance of power showed a little bit of improvement. It's above the dashed line or the midpoint. And after giving us a pretty high reading with the CMB composite, it did decline. Just wanted to update you with this. The one that I'm looking at the most is the anchored moving average going back to the COVID low, where this had been acting as overhead resistance. We broke above that and then closed down below it. So this is another area that we want to see if can be conquered if things are going to continue to be more positive. The Heiken Ashi, based on the trend here, that's still looking okay. The Kegi is still more positive. The Renko is still looking more positive. The three-line break is still positive. Nothing changed here with our point and figure chart after the green X was added yesterday. And the Elder Impulse is still positive for the S&P. We came right up to this moving average, and then we closed down below that, and we're still positive with the SPY. With the SAR, the stop and reverse, we continue to be positive. We're still purple with the no-go system. We're still showing a little bit of flat to slightly better signs with the 50, 150, and 200-day longer term moving average. Going back 200 periods, we're trying to come up out of this trough that we set back at the COVID low. So that's oversold still. So longer term, we're still dealing with some oversold conditions, while in the short term, we're dealing with overbought conditions. Special K trying to turn up. And going back 250 periods, also coming down to the COVID low and trying to bounce. The diamonds are still positive, even though this is not a real good looking bar here where you open, you go up, and then you come down and close where you opened, but it's still maintaining a green bar at this time. So yeah, we're still above the 50 period moving average, but to go up that high and then come back down is never a good sign. Where the Qs have switched back to neutral, and we were above the pivot yesterday. Well, we dropped below the pivot, and this is where we saw more of the weakness. Even though there was a down day, and this is just crazy. On a closing basis, the Vixen, which is the VIX for the NASDAQ 100, it still continues to fall. And the NASDAQ, after coming above the pivot, has now closed below the pivot. The mid caps came right up to this resistance and then came back down, but they're still above their 50 period moving average. The Wilshire, after coming up to its 50 period moving average, has now been closed, continues to close below it. It was just right below it yesterday. The Dow, looking at Dow theory, we were pretty much flat with the Dow, seeing a little bit of improvement with the transports, and we were pretty much flat with the utilities. The dollar, it was down over 1%, still in an overall uptrend, but has dropped below the 50 period moving average. The dollar to the S&P still having a tendency to go in opposite directions. Gold was up 0.64%, but is still in a downtrend. Silver was up 0.67%, but still in a downtrend. Oil bounced up over 3% to 87.91, and S&P to oil is neutral right now. And let's see, bonds. Saw a little bit of an advance based on price with our total bond ETF, and we were up about 0.2% with our world bond index. And then here's are the yield curves. The 10 to the 5, that's been inverted for a while. The 30 to the 5, it went positive yesterday only to slightly drop back down into being inverted. Now, the 10 to the 2 still remains inverted. The 10 to the 3 month has dropped back down into the inverted area. Yields have been coming down with the 10-year. We're down to 4.015% on the 10-year. And here's just showing how we really hit up and now are coming back down. The 30-year, after spiking up to 4.4%, has now declined to 4.19%. And this is just showing how over the last couple of days, how interest rates have declined, but the 2 years still giving you the best yield. Some of these lines are crossing each other as all this weird stuff is happening. And that's why we're seeing some of these inverted yield curves. Stocks to bonds, they're neutral right now. And the S&P to the 2 year, after being neutral, dropped a little bit. So they're trying to get back to that moving in opposite direction relationship. The S&P to the 10-year also coming back down close to neutral, but still having a tendency to go in the same direction. Tech to the 10-year, the same thing. They're still going in the same direction, but this is falling and could drop into neutral territory. To update our charts, still looking okay with our 19-day exponential moving average of the advanced decline line. We're still kind of where we were yesterday based on price and volume. So that's still looking valid currently. The stocks above their 200-day simple moving average still holding up, even though it actually advanced a little bit. The 50, and this will be more sensitive to short-term price movement. It did decline just a little bit with the S&P, with those stocks above their 50-period moving average. The mid caps are still holding up, and the small caps continue to hold up. The 10-day average of the highs minus the lows is still showing some improvement. It's picking up some of the strength now. That's being included in part of the calculation. So we actually saw this advance on a down day. And then broad market, looking at the highs and lows over 5 periods, it's still negative overall, but showing some improvement after giving us this extreme negative reading. The equity put call ratio still continues to fall after giving us this extreme spike. And then the small caps, they're still above their 50-period moving average, and they're still above this pivot level. So that's why this chart held up better. And they were actually up 0.35%. So that means that the small caps outperformed the S&P. That's why we saw the ratio go up. And we're seeing not really a new spike yet, but the red line really did outperform the blue line. This is what we're watching for. Can we get another spike out of this? And then will that afterwards end up giving some support to the S&P 500? Our sectors, we saw a decline with the Qs. We're flat with discretionary. Large cap was rolling over. This is kind of disappointing right now. We're just not seeing a lot of follow through. But since the mid caps and the small caps held up, we saw a little bit of improvement here, but they're still below a declining moving average. The S&P utilities ratio did decline a little bit, but overall, this is still holding up quite well. The 2-year, we don't know if this is spiked. It came down a little bit, but until we see a real definitive spike here, it's going to be really hard for us to use this as a signal. The staples were up 0.2%. And so even though this ratio did decline, we have not taken out this spike that we're seeing right now. The Copic curve is still giving a valid signal, as is the Pring bottom fissure, but we're starting to get to a pretty extreme reading currently. Is this signal starting to wear itself out? So what's our outlook then for Thursday? The technicals, we saw the decline after being overbought and hitting resistance. That's in the S&P, but things are still hanging in there, but they haven't worked off this overbought condition yet. We have advanced third quarter GDP coming out. That's a biggie, and the market's really going to be anticipating that. We have weekly jobless claims coming out, as well as durable goods. Then the whole list of geopolitical events right for the next 2 days, unless one of these other events really comes to the forefront. It's going to be inflation and interest rates because of GDP, because of what the PCE report coming out on Friday. So our scenarios can't really go with the down scenario because we're seeing a lot of improvement and the market is still holding up right now. But there's a lot of these headwinds that are out there that, if they're negative, could really shoot things lower. The technicals are trying to stay positive after being short-term overbought and hitting resistance. If we work off this overbought situation, let me drop down here, and we can get enough volume to push us through resistance, that would really help the overall picture look much more positive. In our scenarios, some of them are showing improvement, some of them with the sector rotation pretty much still showing weakness. Our setups, some are improving, some are staying the same, some are declining slightly with the down day. The technicals, they're showing improvement. All of our oscillators are positive. We're still above the 50-period exponential moving average. We're holding up in some areas and in some indexes with the pivots and the Fib retracements. So not a lot of damage has been done, but where do we go from here? And is that going to add to the positive side or add to the negative side? And we're not neutral now because the ADX is weakening. It just recently crossed over to positive and is still above 20. So our conclusion, the S&P is trying to turn positive, but declining after becoming short-term overbought, as well as hitting resistance. And that's pretty much what's happening in the short term. Intermediate term, we're still possibly becoming overbought in some areas. And then long term, even though I don't have that, we're still having some extreme negative readings on our long-term charts that are trying to show some improvement. But as long as we're below that 200-day simple moving average, our long-term trend will also remain negative. So thank you. Have a wonderful Thursday. We'll look things over, see how the market reacts, and I'll look to prepare either a full-length video or at least a daily brief for Friday's session.